I mean, you're a skeptic about quantitative easing, period.
Well, I think the way to think about it, Margaret, is to observe the economy is not measuring up, and the Fed is going to change the ruler. That's what this boils down to. I think the important thing to begin with is to speak more plainly and to lift this semantic fog the Fed is only too happy for us to participate in. They talk about quantitative easing or long-term asset accumulation. No, it is money printing. And what they intend to do is to generate a cheaper dollar, otherwise known in the trade as a debased dollar, and with this inflationary dollar to make everything seem better. That is the agenda. One of the difficulties is that the dollar is truly the world's currency. More than half of the greenbacks in circulation change hands outside the 50 states. A good portion of our tradable public debt is on the balance sheets of our creditor central banks. So while the dollar is the world's currency, the Federal Reserve is America's central bank, America's and only America's. And it seems to have no appreciation of this terrific franchise that the dollar has. The dollar is the Coca-Cola of world monetary brands. It is a great asset. It's probably America's greatest export. And the Fed is in the business of making dollars much more plentiful, where most of the world is no thank you, we have enough of them. So the Fed is running a great risk, I think, in cheapening the dollar, as it is evidently intent on doing. Yesteryear, not so long ago, but in the 50s and 60s, there's 1950s and 60s, there was a little fashion for the idea of just a little bit of inflation. 2 or 3%, some of these theorists thought, would be just what we needed. It would impart a lilt to our economy. It would make everyone feel a little bit more prosperous. You'd get up in the morning with a little spring in your step because everything was getting higher. And this was called creeping inflation. And some of the advocates were the most learned segment of the professorial class. So this idea gained wide circulation and no little credence, but it was met tellingly by the most orthodox central bankers as rank heresy. There's a fellow at the Atlanta Federal Reserve, in fact, the president of that regional Federal Reserve Bank, named Malcolm Bryan. And Malcolm Bryan regarded the premeditated creation of inflation by the Fed as an act of moral affront. It was a sin in his view, and he spoke with an almost evangelical fervor against it. So fast forward to the present day, which is not so far forward in the scheme of time, and creeping inflation, by another name, has been instituted as official policy. We call it inflation targeting. Our monetary masters seek 2% a year, which in their self-delusion they think they can deliver. Say at a given level of prices, there's more stuff for sale. More things, more cheaply priced is in fact what you find when you walk into Costco or Walmart. I'm astounded at the sheer volume of merchandise and of its accessibility. Okay, so that's one observation. So that's everyday low prices, right? It's everyday low and lower prices. Explain again, Mr. Fed, what's wrong with that? It's what many Americans spend all weekend looking for, right? And we are meant to understand, our Fed experts tell us, that this is somehow dangerous. So I would ask us all to reconsider if stable prices in a time of rising productivity growth and of profound historic expansion of the world's productive apparatus, if stable prices ought not to mean Walmart kind of everyday low and lower prices. So the Fed, I think, does not believe that. So to give us stable prices, it has to create more credit to compensate for the Walmart effect at retail.
Jim, the gold standard. You've been an advocate of the gold standard for a long time.
I was an advocate of the gold standard when there actually was a gold standard.
Yes,
in 1914. It would take a terrific collective rethink, and it would take a great unfrocking of the authorities and the experts who now not only who don't even disagree with this. It's worse. They don't just say, "Grant, you're wrong." They say, it's a smiling condescension one can't stand.
They dismiss it.
Right. Sorry. Right. So, but I think if I'm right, and I think I am, if I'm right about the dynamics of the federal debt, if I'm right about the absence of a check on our continued running of the most profligate deficits. And if I'm right about the essential, the political, the social and political immorality of monetary arrangements as they now exist, that is to say, savers getting nothing and the speculators getting most everything, it seems to me not only is the mathematics of a gold standard compelling, but also the politics are compelling. This is a prime example of the unintended consequences of this massive intervention by our central bank.
You think it's increasing actual exposure or pushing people
Sure.
towards
Yeah.
What is Bernanke going to say about how, Greece is really changing the trajectory of the global economy? Is it?
Well, I don't know if the Greece has changed. I think that the monetary system, as it has become, as is evolved, is the principal agent of our troubles, or much of our troubles in the world today. I mean, the Fed is we have substituted over the years, we have substituted a gold standard for that. We've substituted a kind of a PhD standard. And as your West Coast tech correspondent was talking, I was listening to Corey, I was thinking, how analog is the Fed? It imposes, through a committee decision of fallible human beings, it imposes a rate on an economy in a kind of a command and control mode. It's utterly unlike anything that is animating the success of, for example, Apple. It seems to me that the Fed is living in the age of black and white TVs with rabbit ears, and the rest of us have moved on into much more sophisticated systems of communication and information flow. We're going to listen to the Fed hand down its decision on what the funds rate should be. How do they know that?
Are you more in the Jamie Dimon sort of worldview here of less regulation would be better? The Fed needs to be looking at this kind of intervention?
The federal regulators have fixated upon capital as the chief consideration of regulatory health of a bank. Long ago, banks had much more capital than they do now. The principal failure in the early years of the Great Depression in this country, Bank of the United States, had no less than 17.7% ratio of capital to equity when it failed in 1930. Capital is not the answer. Capitalism, in my opinion, in the banking system is the answer.
Jim.
Hi, Mr. Grant. I had a question. So when we talk about the Federal Reserve and we talk about how the Fed manipulates or controls interest rates, what would that look like if we didn't have a central bank? How would interest rates be determined by the market? And what sort of a check would that put on credit expansion and the allocation of resources and goods and services in an economy?
Well, Dimitri, as you know, the Federal Reserve is a relatively recent institution in America. I mean, it's in the past 100 years. And between friends, Dimitri, what is 100 years? It was founded in 1914, having been enacted in 1913. So from the dawn of the constitutional history of America, 1789 to 1913, with some exceptions having to do with earlier variants on central banking, this country was without a central bank. And how do we fix interest rates? Well, there was a supply of credit or savings and the demand for credit and savings. And the marketplace attended to the setting of interest rates rather well. The period 1900 to 1913, for example, in the authority of the terrific and universally esteemed financial economist Charles Goodhart, was perhaps the most successful, certainly one of the most successful periods in American finance. Interest rates were stable, bank failures few, bank earnings strong, nothing like the systemic collapse that we saw, near collapse we saw in 2008 and 9. So in the absence of a Federal Reserve, this country did rather well. It did rather well under the institution of the gold standard.